Joining us now is Bob Brooksmith, Mortgage Bankers Association CEO. Bob, it's good to have you on. Perhaps not surprising that we've seen mortgage rates move higher, given what we've seen in the Treasury market. I mean, is 8% really something that could be on the horizon?
Well, unfortunately, Morgan, it already is reality for a lot of lenders who are quoting rates today, because the numbers that we put out are last week's numbers and the market has continued to deteriorate. We got a little reprieve today, but we really need the 10-year Treasury to come down. And more importantly, perhaps, the spread between the 10-year and the 30-year fixed-rate mortgage is at levels about 125 basis points higher than usual. And we really need some action for that to come in. And a couple of things I have in mind would be the Fed being clear that they're done with rate increases, because we think that volatility in interest rates has increased that spread. And also for them to make clear that they're not going to sell mortgage-backed securities off their balance sheets. But
we know they are, right? I mean, it's quantitative tightening. So I guess how realistic is it to think that even if Treasury yields come down, that you see some of these other pressures? And I know banks have been rethinking their investment portfolios and maybe selling out of MBS too. How realistic is it to think that those forces are actually going to ebb?
Well, when I talk about the Fed's holdings of MBS, of course they are letting them amortize and prepay, but those are at very low levels. I still think some of the increase in the spread between the Treasury and the mortgages is a fear that the Fed would actually sell in the open market existing MBS. So if they were to make clear that that's not on the horizon, I think that that would help. And the bank demand will, I think, come back. We've seen some increase in supply with some of the failed banks' MBS being on the market, but I think that's mostly been resolved now.
Okay. It does feel like this perfect storm. I've heard the word used unprecedented, because you have mortgage rates at these multi-decade highs. You have housing inventory at these historical lows. And then on top of it, you've got home prices that still seem to be moving higher. What is going to actually break this dynamic to create a more affordable housing market?
Well, as rates get back to a more normal level, it will help both with supply and demand. And that may sound not very logical, but as you know, a lot of the reason for the shortage of inventory is that people have 3% mortgage rates and they're not willing to sell their house and take on a 7.5% or 8% mortgage rate. But as rates come back into line, more transactions will get unstuck, the inventory will increase, and then you can see this market moving again. We've got a 44-year low in mortgage delinquencies. So people who have mortgages are paying them. And with unemployment at levels as low as they are, there are plenty of people who can afford the new mortgage rates. They may not like them, and they may refinance when things come down. But there is the demand, and supply is a problem.
And I just got to ask, because we just showed it on the screen, you think rates are actually going to come down from here?
Oh, absolutely. I think that when the Fed finishes, we think they are finished, but when they make clear they're finished, we think that's a very positive signal to the market. And the spreads, as I said, are at historic highs, and we think they'll come in. But it would be really great for the Fed to make that clear.